Hello everyone, welcome to my TA Exam 2 review session. We'll be covering chapters 5 through 9 in this review session. Before we start, here's some general studying tips. At the end of each book chapter, there's a page called Questions. This is an extremely good review of all the concepts covered in each chapter, and it's great prep getting yourself comfortable with the conceptual questions that you're going to be seeing on the exam. Also, at the end of the book chapters, there's the foundational 15 questions. The foundational 15 are a comprehensive set of 15 questions that pretty much cover all the bases in a chapter. And this is a good test of your ability to complete the calculations as well as understanding the concepts at the same time. And I think this would be a good prep to do for each chapter to get a good feel of what the calculation questions are going to be on the exam. And finally, redo all of your homework. The biggest success in Accounting 404 comes from repetition of the calculation problems. So using McGraw-Hill, it makes it convenient to check your work, as well as gives you the option to utilize the SmartBook feature, which is pretty much just more homework problems, but an infinite amount pretty much. And today I'll be going over the 5 chapters. In chapter 5, we'll be doing questions 5-4, 5-5, and then the exercise 5-14. Chapter 6, I'll be going over questions 6-6 and 6-13, and then exercise 6-20. Chapter 7, I'll be going over problems 7-1, 7-4, and exercise 7-13. Chapter 8, 8-3, 8-4, and exercise 8-14. And chapter 9, 9-5, 9-6, and the exercise 9-3. I'd encourage you to follow along in the textbook and try all the problems before I go over the answers. All right, moving on to chapter 5, and we're starting with 5-4 and 5-5. These are 2 quick conceptual problems just to review. What is the operating leverage, and what is the break-even point? If you want to take some time to think about these questions first before moving on to the answer, you can pause now. All right, so your operating leverage measures the impact on net operating income of a given percentage change in unit sales. The degree of operating leverage at a given level of sales is computed by dividing the contribution margin at that level of sales by the net operating income at that level of sales. The degree of operating leverage, I've seen that being tested in a number of different practice problems in the book, so I would totally expect that to be on the exam. So I would definitely review this definition as well as go through the book and look for the exercises that regard calculating and using the operating leverage and degree of operating leverage. And now 5-5, what is the break-even point? The break-even point is the level of sales at which profits are 0. This is a pretty simple definition, but this one's good to remember and good to review as we'll be using it in the next problem. Moving on, we're looking at exercise 5-14. Linden Company is the exclusive distributor for an automotive product selling for $40 per unit with a contribution ratio of 30%. The company's fixed expenses are $180,000 per year, and it plans to sell 16,000 units this year. So what we're required to do in this problem is calculate the variable expenses per unit, what is the break-even point in unit sales and in dollar sales, and then finally what amount of unit sales and dollar sales is required to attain a target profit of $60,000 per year. Starting with question 1, what are the variable expenses per unit? Variable expenses, so in this problem, we're given the sales price of $40 per unit, and we're given the contribution margin, the contribution margin ratio of 30%. So we can reverse engineer the equation to calculate contribution margin, and we know it's going to be sales minus variable cost is equal to your contribution margin, the ratio. So if we're given 100% of sales, we can subtract out the contribution margin, and if we're trying to find that missing variable, the missing variable expenses, well, it's going to be the remainder of that. So 70% of our sales price are going to be variable expenses. So 70% of $40 is now going to be $28. So we know our variable expenses per product are going to be $28. Moving on to question 2, what is the break-even point in unit sales and in dollar sales? We're going to start by taking those numbers we just calculated. So we know the selling price is $40. Think about that as 100% of the sales revenue. Then you subtract out your variable expenses, which is 70% or $28 per unit. And finally, that gives you a contribution margin of 30% or $12 per unit. So if we want to find the break-even point, we pretty much want to find where profit is going to be equal to 0. So where profit's equal to 0 is going to be the unit contribution margin, so what's left over after you subtracted your variable expenses, times an unknown quantity minus the fixed expenses. So you're going to be netting out your contribution margin with your fixed expenses so that it equals 0. So we can set the equation. 0 is equal to $12, which is our contribution margin, times the unknown quantity minus our $180,000 of fixed expenses. And rearranging that equation, we can have 12Q is equal to 180,000. And you divide that 180,000 by 12 to get Q just alone on the left side. And you can divide $180,000 by $12 per unit. And that gives you 15,000 units as the break-even quantity. Now, if you want to figure out what that is in sales, you just have to multiply the 15,000 units times the per unit sales price of $40, and that gives us a break-even point in sales of $600,000. Now, there's an alternative way you can calculate this. If you want to first calculate the sales and then find the units, you set up a similar equation. Profits equal to the contribution margin ratio, so the 30%, times your unknown amount of sales minus your fixed expenses. And you rearrange that equation after you plug in all the numbers, and you're left with sales being that unknown variable. So you want to solve for sales, and you divide the 180,000 of fixed expenses by your contribution margin ratio, and that gives you sales of $600,000. And then if you want to figure out how many units, you just divide those sales by the selling price per unit, and that gives you 15,000 units. All right, going back, looking at question 3, what amount of unit sales and dollar sales is required to attain a target profit of $60,000 per year? So we're going to use that same exact formula that we used in the last question. Profits equal to your unit contribution margin times the unknown quantity minus your fixed expenses. But this time, instead of setting profit to 0, so not the break-even point, we're trying to find a profit of 60,000. So we're going to have 60,000 starting on the left-hand side of the equation, and you have to rearrange the equation to single out the variable Q because we're trying to find that unknown quantity the unknown quantity of products sold. And after rearranging the equation, you have 12Q is equal to $240,000. Divide that 240,000 by 12, and that leaves you with a Q of 20,000 units. And again, you can convert that into dollar sales easily by just multiplying the amount of units times the selling price per unit. And here is the alternative scenario where you start with calculating the sales first, and then you divide it by the selling price per unit to get units. But we've all gone over that already. Okay, moving on with Chapter 6. We're going to start with 6-6 and 6-13 conceptual questions. 6-6, if units produced equals the units sold, which method would you expect to show the higher net operating income, variable costing, or absorption costing, and why? And 6-13 is going to be distinguish between a traceable fixed cost and a common fixed cost, and give several examples of each. All right, 6-6. We're going to be looking at the difference between absorption and variable costing. This is going to be definitely tested on the exam, so I'd know the difference between these two. But so for this question, if production and sales are equal, net operating income should be the same under absorption and variable costing. A little bit of a trick question. When production equals sales, inventories do not increase or decrease, and therefore under absorption costing, the fixed manufacturing overhead cost cannot be deferred in inventory or released from inventory. So since we're not carrying over any inventory into the next month, there's going to be no fixed cost tied up on our inventory account. It's all going to be accounted for in the net income for the end of that month. And we'll be going over that a little bit more at the within the next problem. And 6-13, what's the difference between the traceable fixed cost and a common fixed cost? Again, something that's going to be tested on the exam. A traceable fixed cost of a segment is a cost that arises specifically because of the existence of that segment. If the segment were eliminated, the cost would disappear. A common fixed cost, by contrast, is a cost that supports more than one segment, but is not traceable in whole or in part to any one of the segments. If the departments of a company are treated as segments, then examples of the traceable fixed costs of a department would include the salary of the department supervisor and depreciation of machines used exclusively by that department. So it's specific to that department, it's traceable there to that department. Examples of a common fixed cost would include the salary of the general counsel of the entire company, the lease cost of the headquarters building, corporate image advertising, and depreciation of machines shared by several departments. So even though they're used in departments, if it's shared by multiple departments, you can't trace that fixed cost back to any specific department. Moving on to the calculation problem, 6-20. High Country Inc. produces and sells recreational products. The company just opened a new plant to produce a folding camp cot that will be marketed throughout the United States. The following cost and revenue data relate to May, the first months of the plant's operation. So since it's the first month of operation, their beginning inventory is going to be 0. In this month, they produced 10,000 units, but they only sold 8,000 units. So that's important to remember. They didn't sell all of their units, and they're going to have units left over in inventory. Their selling price per unit was $75, and their selling and administrative expenses for the variable expenses, it was $6 per unit, and they had a fixed selling and administrative expense of $200,000 per month. As far as manufacturing costs go, their direct materials were $20 per unit, direct labor was $8 per unit, and the variable manufacturing overhead is $2 per unit, and their fixed manufacturing overhead cost per the month was $100,000. So in this problem, we're going to be looking at how to calculate net operating income through absorption costing and through variable costing. So we're going to start with question 1. Assume the company uses absorption costing. And we're going to be calculating the camp cot's unit product costs, as well as prepare an income statement for the month of May, aka just calculating that net operating income at the end of the month of May. For question 2, we're going to be using variable costing, again, calculating the unit product cost, and then preparing the income statement for May using variable costing. And then finally, for question 3, we're going to explain the reason for the difference in the ending inventory balances under these two costing methods and the impact of this difference on the reported net operating income. So we're going to start with question 1, looking at absorption costing. We can calculate the unit product cost under absorption costing by adding direct materials, direct labor, and variable manufacturing overhead. And then, since it's absorption costing, we're also going to add in fixed manufacturing overhead per unit. So when you know that fixed manufacturing overhead is going to be $100,000 per month, and this month we produced 10,000 units, so that leaves $10 per unit of fixed manufacturing overhead, and you combine those all together, 20 plus 8 plus 2 plus 10, that gives you an absorption costing unit product cost of $40 per unit. So now to calculate our net operating income using that $40 per unit, we're going to take sales, so 8,000 units of sales times $75 per unit, and that gives us $600,000 of sales. Our cost of goods sold, since we only sold 8,000 units, we know it costs us $40 per unit to make. That's going to be 8,000 times 40, 320,000 of cost of goods sold, and that gives us a gross margin of 280,000. And so now in absorption costing, you want to calculate the sell. This is when you add in the selling and administration expenses. So you add in the fixed and variable at the same time. So it's $200,000 in fixed expenses for the month plus the variable amount. We know that we sold 8,000 units times the $6 per unit of variable expenses, and that gives us $240,000. You subtract the cost of goods sold, you subtract the selling and administrative expenses from the gross margin, and that gives you net operating income of $32,000 using absorption costing. And the main difference here, the main thing we need to focus on here is when we're throwing in the fixed manufacturing overhead expense and how we're expensing that per unit. Now, question 2, we can see that we're going to be doing that same process, but for variable costing, so it's going to be a little bit different. Variable costing, the unit product cost is going to be direct materials plus direct labor plus your variable manufacturing overhead plus the variable, and just those three, and that gives you your variable costing unit product cost. And so the difference here is we're not using this fixed manufacturing overhead to calculate our unit product costs. That's going to be used later in the calculation. So that's important to know the difference between absorption costing and variable costing is when you're calculating the how much of that fixed manufacturing is being expensed that month and to which account. So using that $30 in variable costing unit product cost, we can calculate the net operating income for the month of May. So we have sales, 8,000 units that we sold times $75 selling price gives us $600,000 in sales. Now we're going to subtract out all of our variable expenses. So we're going to subtract out the variable cost of goods sold. We know it's $30 times the 8,000 units sold, as we calculated above. And then we're going to subtract out our variable selling expenses. So that's the selling and administrative expenses of $6 per unit. And you can add those two together to get $288,000. And as you know, to calculate contribution margin, you take your sales minus your variable expenses, gives you a contribution margin of $312,000. Now, this is when you're going to subtract out all of your fixed expenses. So we're left with two fixed expenses. That's going to be fixed manufacturing overhead of $100,000 and fixed selling and administration expenses of $200,000. So a total of $300,000 in fixed expenses, leaving our net operating income of $12,000. Now, you may be wondering, how is the net operating income $12,000 here, but $32,000 using absorption costing? And that comes down to how we expensed our fixed manufacturing overhead. So that's pretty much what question 3 is asking us. Explain the reason for any difference in the ending inventory balances under the two costing methods. So question 3, the difference in the ending inventory relates to a difference in the handling of fixed manufacturing overhead costs. Under variable costing, these costs have been expensed in full as period costs. So we subtracted out at the end for the full $100,000 amount. Under absorption costing, these costs have been added to units of product at the rate of $10 per unit. So remember when we calculated the cost per unit, it's $10 per unit. In absorption costing, because we're adding it to the per unit costs, we're only going to expense, or we're only going to track the $10 per unit times the 8,000 that we sold. So under absorption costing, a portion of the 100,000 fixed manufacturing overhead cost for the month has been added to the inventory account rather than expensed on the income statement, because at the end of the month, we're left over with 2,000 units. And the problem, we only sold 8,000 despite producing 10,000. So we're left over with 2,000 at the end of the month, times that $10 per unit, which means we left out $20,000 from our income statement and added it to the inventory account because it's rolling over into the next month in ending inventory. So the amount of total manufacturing overhead cost that was expensed that month on the income statement was $80,000 because it's the 8,000 units times the $10 per unit instead of the full $100,000. So there's going to be that $20,000 difference between the two methods. And because 20,000 of the fixed manufacturing overhead cost has been deferred in inventory under absorption costing, as I just explained, the net operating income under that costing method is 20,000 higher than the net operating income under variable costing, as shown in parts 1 and part 2 above. So hopefully that makes sense. And yeah, make sure you definitely review the difference specifically of which can be more beneficial to the company at the time, which costing method they're going to choose based on the net operating income they want to show at the end of the month here, because there can be quite a bit of a difference, and it can be a little bit tricky to calculate why there is that difference, but it's all about the fixed manufacturing overhead and when that's being expensed. Moving on to Chapter 7, we're looking at 7-1 and 7-4 conceptual questions. 7-1, how does activity-based costing differ from traditional absorption costing? And 7-4, what are unit level, batch level, product level, customer level, and organization-sustaining activities? These are all important to know the difference between all of these when we're looking at activity cost pools, which I'll be going over in the next problem. But to answer these questions first, 7-1, activity-based costing differs from traditional absorption costing in a number of ways. In activity-based costing, non-manufacturing as well as manufacturing costs may be assigned to the products. And some manufacturing costs, including the cost of idle capacity, they may be excluded from product costs. In activity-based costing typically includes a number of activity cost pools, each of which has its unique measure of activity. These measures of activity often differ from the allocation bases used in traditional costing systems. And 7-4, looking at the different level activities, starting with unit level activities. Unit level activities are performed for each product that is produced. So each unit that is produced is a unit level activity. Batch level activities are performed for each batch, regardless of how many units are in the batch. So it's kind of a group of units, but produced in a batch. So it's pretty self-explanatory in the name. Product level activities must be carried out to support a product regardless of how many batches are run or units produced. So this is kind of like the next step above. It's the entire product, regardless of how many batches are run or how many units within a batch are run. They must be carried out to support the product. Customer level activities, they must be carried out to support the customers, regardless of what products or services they buy. So regardless of any of the products, these customer level activities must always be carried out because it has to support the customer, regardless of what goes on even with our products that we're making and what activities we do for those products. And finally, the top of the pyramid, the organization sustaining activities are carried out regardless of the company's precise product mix or mix of customers. So don't focus on any of the products, don't focus on any of the customers. Simply what's activities are designed to keep the organization sustaining, keep the organization alive. Those are organization sustaining activities. So I would know the difference between all 5 of these and be able to select out from a list of activities where that activity may fall in of these 5 here. Moving on to question 7-13, we're going to be looking at this exercise. Fogarty Company makes 2 products, titanium hubs and sprockets, and the data of the 2 products follows. So for the hubs, it's 0.8 direct labor hours per unit, and they produced 10,000 units of hubs. And for sprockets, it takes 0.4 direct labor hours per unit, and they made 40,000 units. Additionally, hubs require $32 in direct materials per unit, whereas sprockets require only $18 per unit of direct materials. The direct labor wage rate is $15 per hour, so we're going to multiply that by the direct labor hours used per unit to find the direct labor for each unit. C, hubs require special equipment and are more complex to manufacture than sprockets. And finally, the ABC system has the following activity cost pools. So as I mentioned in the last review of those conceptual problems, there's different activity cost pools with the activity measure listed. So there's 3 in this problem. You have machine setups, so it's going to be counting the number of setups. You have special processing, known as machine, or that's going to be calculating machine hours. And we know that the hubs require special equipment or more complex. So only the hubs are going to be using this special processing. And finally, we have general factory or organization sustaining activity cost pool. And you can see all the costs here, the estimated overhead costs for these 3 pools, as well as the activity broken down by product. So for machine setups, we're doing 100 for hubs and 300 for sprockets. Special processing, 5,000 for hubs, none for sprockets. And the general factory, since it's not related to one specific product, there's no activity assigned per product. It's just sustaining the entire factory, the entire organization, and that gives you an estimated cost of $816,000. So what's required? We want to compute the activity rate for each activity cost pool, and it's asking us, did you compute an activity rate for all of the activity cost pools and why? And then we're going to be determining the unit product cost of each product according to the ABC system. All right, so question 1, we're looking for the activity rate for each activity cost pool. So to start with machine setups, it's estimated the overhead cost is going to be $72,000, and the expected total activity, so sprockets and hubs, is going to be 400 setups. And if you divide those two together, or divide the estimated overhead cost by the expected activity, that means it's going to be $180 per setup. For special processing, the estimated overhead cost is $200,000, and it's estimated that there's going to be 5,000 machine hours used. We know that's only in the hubs, and so that gives us $40 per machine hour. You just divide this by that. And there's going to be no activity rate for the general factory activity because it's an organization sustaining activity, and organization sustaining costs should not be allocated to the products because this is just a general cost that's to keep the factory supported, keep the factory running, and it can't be directly tied back to specifically the hubs or specifically the sprockets since it's just the entire organization. So we're going to use these activity rates we calculated for these 2 activity cost pools to now calculate the unit cost per special product. So we know there's 2 products, hubs and sprockets. So we want to find how the overhead's being assigned to these different products based on the cost pools. So for machine setups, we know we just calculated it's going to be $180 per setup, and hubs, as we know in the problems given to us, are doing 100 setups. So 180 times the 100 setups gives you an ABC cost of $18,000. For special processing, it's going to be $40 per machine hours we calculated in the last step. And for hubs, we use 5,000 machine hours. So you get a total of 200,000. You add those 2 together, and that gives you a total of $218,000 in overhead for hubs. Now looking at sprockets, we're going to figure out how much overhead. $180 per machine setup, and this one's using 300 setups, again, as given to us in the problem here, that there's going to be 300 setups for sprockets. That gives you an ABC cost of $54,000. For the special processing, since the sprockets are less complex than the hubs, there's going to be 0 machine hours used for special processing, and so that's going to be $0, and that means our total manufacturing overhead is going to be $54,000. So now we want to calculate the unit costs, and as you've seen 1,000 times in this course, you add direct materials plus your direct labor plus your overhead. That's kind of those are the big 3 in this class. And so you start with your direct materials. It was given to us in the problem that it costs $32 per unit for hubs and $18 per unit for sprockets. Now direct labor, again, it was given to us that it's $15 per direct labor hour, and it was given to us that it takes 0.8 direct labor hours per unit of hubs and 0.4 direct labor hours per unit for sprockets. So you can multiply that 15 by that 0.8 and 0.4, and that gives you $12 per unit and $6 per unit. Now, finally, our overhead costs. We just assigned overhead based on the cost pools to our different products. So for hubs, 218,000 divided by the 10,000 hubs that we produced. And again, that's given to us in the annual production. We made 10,000 units. So $21.80 per unit. For sprockets, our total overhead is $54,000 and we produce 40,000 units. So that's $1.35 per unit. And we can add the direct materials plus direct labor plus overhead together. And that gives us our unit cost for the hubs and the sprockets using the activity cost pool system, using the ABC system. All right, moving on to Chapter 8. We're looking at 8-3 and 8-4 conceptual questions. What is a perpetual budget and what is a master budget and what schedules comprise it? All right, 8-3, a perpetual budget is a 12-month budget that continuously rolls forward 1 month or quarter at a time as the current month or quarter is completed. This approach keeps managers continually focused 1 year ahead. Now, looking at a different type of budget, a master budget represents a summary of all of management's plans and goals for the future and outlines the way in which these plans are to be accomplished. The master budget is composed of a number of smaller, specific budgets encompassing sales, production, raw materials, direct labor, manufacturing overhead, selling and administrative expense, and inventories. The master budget usually also contains a budgeted income statement, budgeted balance sheet, and a cash budget. Make sure you know what makes up a master budget, as well as what's it composed of, what I listed out here, and know the difference between the master budget and a perpetual budget. And I'd do some more calculation problems that focus on these two concepts here. Moving forward with 8-14, the exercise. The marketing department of Jesse Corporation submitted the following sales forecast for the next year. Their budgeted unit sales for the first quarter were 11,000, second quarter 12,000, third quarter 14,000, and fourth quarter 13,000. The selling price of the company's product is $18 per unit. Management expects to collect 65% of sales in the quarter in which the sales are made. So in the quarter, 65% of these budgeted sales are going to be collected, and 30% of those sales are going to be collected in the following quarter, and 5% of sales are expected to be uncollectible. And the beginning balance of accounts receivable, all of which is expected to be collected in the first quarter, is $70,200. The company expects to start the first quarter with 1,650 units in finished goods inventory. Management desires an ending finished goods inventory in each quarter to be equal to 15% of the next quarter's budgeted sales. The desired ending finished goods inventory for fourth quarter is 1,850. So it's important to write down and keep track of all these numbers. As you can see, there's about 10 numbers we all got to keep track of here in order to solve this problem. So what's required? Calculate the estimated sales for each quarter and for the year as a whole. Number 2, calculate the expected cash collections for each quarter and for the year as a whole. And finally, calculate the required production in units of finished goods for each quarter and for the year as a whole. So we're going to be breaking down each quarter, and then we're going to be pretty much summing those together to get the year as a whole. So starting with question 1, we're calculating the estimated sales for each quarter and for the year as a whole. All right, so we know the budgeted unit sales were 11,000, 12,000, 14,000, 13,000 for each of the quarters. If you sum those together, you get 50,000 for the year. And the selling price stays the same throughout the entire year. It's $18 per unit. So simple math, we can find the total sales in dollars for each quarter, and you sum those together to get 900,000 for the year. So question 1, pretty simple, just multiplying the budgeted sales or unit sales by the selling price. Now, number 2, we're using that total sales we just calculated, and we're going to calculate how much we're actually collecting in that quarter. So as we know in the problem, it told us that we were beginning the year with $70,200 in cash that we're going to collect in the first quarter. So we're going to start out with the 70,000. And with our sales, we know that we collect 65% in the quarter. So 65% of 198,000 sales, we're going to collect that 128,700 for that quarter. So that brings our total that we're going to collect in just the first quarter is going to be 198,900. Now, the remaining 30%, excluding that 5% that's uncollectible, is going to be collected in the next quarter. So 30% of 198,000 total sales is going to be collected in quarter 2, and 30% of 198,000, if you do the math, is 59,400. So that's going to be basically our beginning balance, our starting balance for this quarter. And then we're going to collect 65% of second quarter's total sales, and that's 140,400, bringing our total for the second quarter 199,800. In quarter 3, we're going to collect that 30% from the last quarter. So 30% of 216,000 is 64,800. We're collecting that in the third quarter. Now we're collecting 65% of the third quarter's 252,000, and that's 163,000. Totals to 228,600. In the fourth quarter, again, we're collecting 30% from the previous quarter, which is 30% of 252 is 75,600, plus the 65% of the current quarter, so 152,100. That gives you a total of 227,700. Now for the year, we can sum up these totals on the bottom here. So each quarter's total cash collections brings us to a total of $855,000. So pretty straightforward. Just have to be careful with multiplying by the right percentages of which you're collecting in each quarter, making sure you're still collecting that 30% from the previous quarter, or rolling forward the 30% if you do the math while doing the first quarter calculations. And finally, we're going back to question 3. Calculate the required production in units of finished goods for each quarter and for the year as a whole. All right. So we start with our budgeted unit sales. So 11,000, 12,000, 14,000, 13,000. For the year, that's 50,000 budgeted unit sales. And we know that so we're trying to figure out the required production in units for each quarter. So we're going to take our budgeted sales plus our ending inventory minus our beginning inventory to figure out how much we need to produce for this quarter. So we're starting with the 11,000 sales, and then we're going to add on the amount we already have in ending inventory. And I believe it tells us in this question that it doesn't. We have to do the calculation. So for the first quarter, we want our ending inventory to be 15% of the next quarter's budgeted sales. And it tells us that here management desires an ending finished goods inventory in each quarter equal to 15% of the next quarter's budgeted sales. So 15% times the next quarter's 12,000 sales, that gives us 1,800 of ending inventory. So the total needs for this first quarter is going to be 12,800. And we already were given 1,650 in beginning finished goods, and that one is given to us in this problem. The company expects to start the first quarter with 1,650 units in finished goods inventory. So that means what we need to produce this quarter is 11,150. Moving into quarter 2, we're budgeting to sell 12,000 units. Our ending inventory is 15% times this next quarter's amount, which is 2,100. So our total needs is 14,100 minus the beginning amount we have, which our beginning amount is just the ending amount from the last period. Because we ended quarter 1 with 1,800, so we're going to begin quarter 2 with 1,800. So we can subtract out our beginning amount, and that gives us 12,300 in production units. It's going to be the same thing for quarter 3 as it was for quarter 2. So I can skip over that. You just have to figure out the ending inventory. It's just 15% of 13,000. Beginning is the same as the ending of quarter 2. Gives you required production units of 13,850. Now we get to quarter 4. We need to figure out how much we have in ending inventory, but we don't have another quarter to multiply by the budgeted sales. And it tells us in this problem that the desired ending finished goods inventory for the fourth quarter is 1850. So we don't have to worry about that. It gives us that number, the 1850. So our total needs is 14,850 minus the beginning finished goods inventory, which is the ending of quarter 3, and that gives us 1950. So our required production is 12,900 for quarter 4. Now looking at the full year, so our budgeted unit sales for the entire year is 50,000. Our ending finished goods inventory is going to be the ending amount we have at the end of quarter 4, because that's the final quarter of the year. So the ending amount quarter 4 is going to be the ending amount for the entire year, so the 1850. So our total needs is 51,850, and we need to now subtract out our beginning finished goods inventory. And so we're going to look to quarter 1 because that's the earliest quarter in the year where we have a beginning amount. So the beginning amount in the beginning of the year, which is quarter 1, 1650. So that means our required production in units is 50,200. All right. On the final chapter, chapter 9, we're going to start with 9-5 and 9-6 conceptual questions. 9-5, what is an activity variance and what does it mean? And 9-6, if the actual level of activity is greater than the planned level of activity, would you expect the activity variances for variable expenses to be favorable, unfavorable, or a combination of the two? So I'll give you a second to answer these questions by yourself, and then I'll move forward. All right, 9-5. An activity variance is the difference between a revenue or cost item in the flexible budget and the same item in the static planning budget. An activity variance is due solely to the difference in the actual level of activity used in the flexible budget and the level of activity assumed in the planning budget. Caution should be exercised in interpreting an activity variance. The favorable and unfavorable labels are perhaps misleading for activity variances that involve costs. A favorable activity variance for a cost occurs because the cost has some variable component and the actual level of activity is less than the planned level activity. An unfavorable activity variance for a cost occurs between the cost and has some variable component and the actual level of activity is greater than the planned level of activity. I know for me, when I took this class, I was always getting confused between the difference of favorable and unfavorable. And it's totally just, you just got to take a step back and really look at it. If the revenues are better than what you planned for, that's going to be favorable. If the costs are higher than what you planned for, that's going to be unfavorable. So you want to make more money than you planned for, but you don't want to spend more money than you planned for. And when you're going through the problem, it's sometimes easy to forget which ones are revenues and which ones are revenues and which ones are costs, because they all just look like numbers on one sheet. So definitely pay attention to whether or not you're working on revenues or you're working on expenses, because whether or not they're favorable and unfavorable is totally dependent on whether or not it's a revenue or an expense. So I definitely review these type of problems, working on favorable and unfavorable, and working with activity variances. And now 9-6, if the actual level of activity is greater than the planned level of activity, would you expect the activity variances for variable expenses to be favorable, unfavorable, or a combination of the two? Kind of as what I just explained in this last problem, if the actual level of activity is greater than the planned level of activity, the activity variances for the variable expenses will be unfavorable, because we're looking at expenses here. If your actual level of expenses is more than what you planned for, then that's not good. That's going to be unfavorable because you're spending more money than what you originally estimated and what you planned for. So pay attention again to whether or not you're working on expenses or revenues when deciding if it's favorable or unfavorable. More on that, we'll be looking at exercise 9-3 in the textbook. Quilcene Oystera farms and sells oysters in the Pacific Northwest. The company harvested and sold 8,000 pounds of oysters in the month of August. The company's flexible budget for August appears below. So the flexible budget is going to be what you're planning or estimating for that month, and the actual results for August are over here. So we're going to be comparing the difference between what they planned in the flexible budget versus what they actually produced in the actual income statement for the month ended August. And we're going to be deciding whether or not those are favorable or unfavorable changes. So you can look through these different numbers here. In both the flexible budget and the actual the actual results, they harvested and sold 8,000 pounds of oysters. The revenue in they planned out revenue of 32,000. The actual revenue was 35,200. And you can go through all these expenses here and see the differences between what they planned in the flex budget versus what actually happened. So what we're required to do in this problem is calculate the revenue and spending variances for August. All right. So starting with revenue, we saw that they actually produced a revenue of 35,200, where they planned in the flexible budget of 32,000. So that's a revenue and spending variance of a positive 3,200. And so since we made more money than what we estimated in our flexible budget, that's going to be a favorable change here. That's a favorable variance because obviously making more money is better than not making more money. For our expenses, the packing supplies, so we actually spent 4,200 on packing supplies, and we planned for spending 4,000. So that means we spent $200 more on packing supplies. So that's going to be unfavorable. We didn't plan to spend that much, but we actually spent $200 more. So that's an unfavorable change between the actual results and the flexible budget, also known as the variance between the two. For oyster bed maintenance, we actually spent $3,100 where we planned $3,200. So we spent $100 less than what we planned. So that's a favorable variance of $100. For wages and salaries, we spent $5,640 where we planned $5,300. So we spent $340 more than what we planned. So that's unfavorable. Shipping, again, we spent more than what we planned. So that's going to be unfavorable for $550. Utilities, we spent less than what we planned. So that means it's a $20 variance, and that's favorable because we spent $20 less than what we planned for. And in other, the actual results were $980, where we planned for $850. So we spent $130 more than what we planned for. That would be unfavorable. So when you add all those expenses together in the actual results in the flexible budget, the total expenses were $21,680 versus a planned $20,580, which means we spent $1,100 more than what we planned for. So that's going to be unfavorable. We spent more money than what we planned for. And when you net that against your revenue, that means you had a net operating income of $13,520, and a net operating income planned of $11,420, which means we made, or in our net operating income, $2,100 more than estimated, which would be a favorable change. So the final net operating income, the final letter you need to focus on in this problem is F. We ended up the whole problem favorable despite being unfavorable in most of our expenses. That concludes the entire Exam 2 review. I hope you guys found it informational, and good luck with the rest of your studying.